You tap your phone, click your mouse, and boom! Just like that, you own a tiny piece of a company. It feels totally instant, right? But in those few milliseconds after you hit buy, a super complex, high-speed race kicks off. So today, we're going to follow that race from start to finish and uncover the hidden journey of your stock trade.
Okay, so you've done the hard part. You picked your stock, you committed, you hit the button. But as your order just vanishes from the screen, a few really important questions pop up. Like, who is actually on the other side of your trade? Where does your money really go? And are you actually helping the company you just invested in? Let's follow your order and find out.
But before we trace the path of a single trade, let's zoom out for a second. There's this fantastic analogy for how the stock market generally behaves. It takes the escalator up, but it takes the elevator down, you know? Gains can be slow, steady, and gradual, but losses, those can happen in a flash. And it's during those sudden elevator drop moments that knowing how the system really works, all the mechanics behind the curtain, can make a huge difference in staying cool and making smart moves.
All right, let's get into it. Step 1 starts with you. You decide, I'm going to buy 10 shares of some company. You log into your app, you place the order. That single click is literally the starting pistol for everything that's about to happen.
Now, you might think your order zips straight to the New York Stock Exchange, but no. First, it makes a crucial stop with a middleman, your broker. You can think of them as your personal agent, your authorized gateway to the entire financial world. So what exactly is a broker? Well, put simply, they're your licensed agent. They're an intermediary who's got the authorization to buy and sell stocks for you. It doesn't matter if it's a huge Wall Street firm or a slick, easy-to-use app on your phone, their main job is exactly the same, to get your trades done.
But a broker's role is way more than just clicking buttons for you. They have a legal duty to find the best possible price. They have to act in your best interest. And in return for that service, they earn a fee. Of course, that old model of charging a commission for every single trade, that's becoming less and less common these days.
Okay, this is where we get to the heart of a really common misunderstanding. We've sent our order to the broker, and they're about to go find a seller. So this brings up a critical question. When you buy shares of, let's say, Apple, is Tim Cook getting your cash to design the next iPhone? I mean, it seems logical, right? You're investing in the company, after all. And the answer for pretty much every single trade you will ever make is no. Your money does not go to the company at all. This is honestly the biggest misconception for new investors, and the reason for it is simple. There isn't just one stock market. There are actually two. And hey, don't just take my word for it. The Roosevelt Institute puts it perfectly. The money you use to buy shares doesn't go to the company. It goes to the other person or institution who just sold you those shares. It's basically a peer-to-peer transaction, and the market is just the place where you meet. So, let's break down these two markets. First, you have the primary market. Think of this like a car dealership selling a brand new car. This is for brand new stock, usually during an IPO or initial public offering. It's the one time a company sells its shares directly to the public to get cash to grow. But after that one event, those shares live on the secondary market. This is the market you see on TV, the NASDAQ, the NYSE. It's like a giant used car lot where investors like you and me just trade existing shares with each other. This is where nearly all the action happens.
Okay, so if you're just buying from some other investor on the secondary market, how in the world do you find each other in a fraction of a second? Well, the market needs someone to always be there, ready to buy what you're selling and sell what you're buying. And for that, we have the hidden hands of the market.
These hidden hands are called market makers. They're usually these massive financial institutions, and their whole job is to provide liquidity. Now, liquidity sounds fancy, but all it really means is that you can buy or sell something instantly at a fair price. Market makers are the ones who make sure that can happen.
Now here's the key thing to remember. Unlike your broker, a market maker does not work for you. Let me say that again. They do not work for you, they work for themselves. They're kind of like a big wholesaler holding a huge inventory of stocks, and they are constantly quoting two prices, a price they're willing to buy at and a price they're willing to sell at. They're the ones that keep the whole market flowing.
So if they don't have clients, how do they make money? It all comes down to something called the bid-ask spread. And it is brilliantly simple. They might offer to buy a stock from sellers for $100. That's the bid price. At the very same moment, they offer to sell that same stock to buyers for $100.05. That's the ask price. They profit from that tiny 5-cent difference, the spread. Now multiply that by millions and millions of trades a day, and you can see how it becomes a very big business.
Okay, so your broker has found a seller through a market maker. Your trade is matched. You're basically done, right? Well, not quite. It's not officially complete just yet. There is one final step to seal the deal, and it's called settlement.
Settlement is the official transfer of ownership. It's the moment your cash is formally swapped for the seller's stock. It's the final handshake that completes the deal. And for a long time, this process wasn't instant. The day you make the trade is called the trade date, but the day it all becomes official, that's the settlement date.
And what's really fascinating is how much faster this has gotten. For years, it took 3 full business days to officially settle a trade. That was called T+3. Then, in 2017, technology helped shrink that down to 2 days. And now, just recently, as of May 2024, the whole system has upgraded again to T+1. Your trade is now officially final and the shares are yours by the very next business day.
So, why does settling a day faster even matter? Well, a shorter settlement cycle actually makes the entire system a whole lot safer. It dramatically cuts down on something called counterparty risk, which is just a fancy way of saying there's a small chance the person on the other side of your trade can't deliver their cash or their shares. By making that window of uncertainty smaller, the whole market becomes more efficient and more stable. It's a massive upgrade to the financial system's plumbing.
So, we followed the trade all the way from your click to the final settlement. But this brings us back to that big question. If our money isn't actually going to the company, then what's the point? Why is the secondary market so important to the economy?
This is where it all comes together. Even though your money isn't going directly to the company, the secondary market is absolutely vital for a few big reasons. First, liquidity. It guarantees that if you want to sell your shares, you can. Without that, nobody would ever buy a stock in the first place. Second, price discovery. All this buying and selling is like the world's biggest, fastest auction, and it helps establish a real-time, fair value for the company. And third, that stock price becomes a powerful tool for the company. A healthy price lets them raise more money more easily in the future or use their stock to buy other companies. So while your individual trade might not have funded a new factory, you're participating in the system that makes all of that possible.
And that brings us right to the edge of the future. We've gone from a 3-day settlement cycle down to the next day. Now we have AI algorithms executing trades in literal nanoseconds. As technology continues to accelerate at this unbelievable pace, it leaves us with one final, pretty mind-bending question. Who, or maybe what, will be the market makers of tomorrow?